Welcome to the deep dive. This is where we try to take that just overwhelming flood of information you see everywhere online and really boil it down. Distill it into the insights you actually need, the stuff you can use. Today, we are strapping in. We're going for a really high velocity look at Bitcoin. Our listener, you, basically want a deep but, fast understanding of this thing. Where did it come from? Where's it going? And the big question, right? Is it actually viable long term? We've got a serious stack of research here pulled together just for you. We're looking at the original white paper context, adoption metrics, lots of on-chain data, and this is crucial, the opposing views, the arguments against Bitcoin being dominant. So our mission today, it sounds simple, but it's huge. We want to unpack whether Bitcoin really solves those systemic problems in traditional finance, and does it actually deserve that title people throw around digital gold? Is that real or just hype? We're trying to get to the why behind all the noise.
Yeah, absolutely. That's so necessary because, when you first start looking into Bitcoin, you realize pretty quickly there's almost no middle ground. It's totally polarized. People either see it as this like revolutionary, decentralized thing, the future of money, secure, inevitable, or it gets dismissed. It's just a risky asset, super volatile, basically speculation, bubbles and crashes. So to cut through that, we can't just look at the price today or tomorrow. We need to look past that. We'll dig into the hard data, things like ROI over, say, 10 years. We'll look at HODL waves. It shows you who's really committed, and the hash rate, which is all about network security. For you, the listener, we're aiming for clarity, structure, maybe some surprising facts in there, but focusing on the mechanisms, the tech and economics behind the big claims without, totally overloading you. Let's start right at the beginning.
Okay, right, origins. And you really have to understand the context here, which was, well, financial chaos. We need to go back to 2009. The global economy wasn't just shaky. It was facing this massive crisis of faith after the 2008 crash. You had the bailouts, right? The moral hazard arguments, this feeling that the big financial institutions, the trusted ones, had completely failed. And it's right into that environment, that feeling of deep mistrust, that this anonymous person or group, Satoshi Nakamoto, publishes the Bitcoin white paper, launches the network, and that very first block, the Genesis block, it actually had a hidden message in it, a headline from the London Times, January 3rd, 2009, about the government bailout of banks. That wasn't random,
No, not at all. And what's so fascinating, I think, is that the goal wasn't just to, like, fix payments. It was about getting rid of the need for trust in the first place. Think about it. Traditional finance runs entirely on trusting intermediaries. Banks, governments, payment processors. You trust them to hold your money, move it, not mess it up. Bitcoin says, okay, let's replace that trust in institutions with trust in math, in verifiable open source common cryptography. It was a direct pushback against those systemic flaws. First, obviously, inflation. Central banks can just print more money, right? That erodes everyone's savings over time. And second, censorship. The fact that a central authority, a bank or government, can just block your transaction or freeze your fund or even take them. Bitcoin's idea. Remove the middleman. Remove that central point of control. Then you remove the single point of failure and you remove the ability to censor.
Which leads us straight into that digital gold idea. It's a powerful comparison. But why gold? Why does that specific analogy stick so hard to something purely digital?
Well, it really comes down to scarcity. That's the core link. And in Bitcoin, that scarcity is like mathematically guaranteed. Gold has worked as a store of value for centuries because it's hard to find, takes energy to mine, it's physically rare. Governments can't just print gold, right? Bitcoin is pitched as a better version of that for our digital age, especially in a world that feels maybe increasingly unstable. It has similar properties, scarcity, difficult to produce, but with this added layer of being digital, easily transferable, and verifiable in a way gold isn't.
Right, and the scarcity isn't just a promise. It's built into the system's rules. That's the crucial part.
It's Denali. This is maybe the most important feature to understand, the bedrock of the whole thing. That absolute fixed limit of 21 million coins, ever. And that's not a policy decision somebody can change later. It's not up for a vote. It's enforced by the network's core consensus mechanism, proof of work, and this programmed schedule of halvings. What that means is, roughly every 4 years, the reward that miners get for securing the network, which is also how new Bitcoin gets created, that reward gets cut in half. So the rate of new supply slows down predictably. It's designed to constantly increase the scarcity, reduce the inflation rate of new coins until that 21 million cap is finally hit sometime way out in the future. That hard cap is the fundamental difference compared to fiat currencies, where governments can and do print unlimited amounts. So when you buy Bitcoin, the argument goes, you're buying a mathematically guaranteed slice of that absolutely fixed pie. That's the engine driving the store of value narrative. You often see things like the stock-to-flow model trying to quantify this predictable scarcity.
Okay, so scarcity is one pillar. But beyond just holding value, that censorship resistance aspect is huge for a lot of people. It's almost political, isn't it? A human rights feature,
Yeah.
some argue.
Oh, absolutely. Think about what borderless, censorship-resistant payments actually mean. Transactions go peer-to-peer. They get validated by this global, distributed network of miners, people all over the world running the software, then recorded on this public ledger everyone can see. No single company, no government can just step in and say, nope, that transaction is blocked, or reverse it after the fact. Now, think about when that becomes really critical. Geopolitical instability, right? Or if a government imposes capital controls, says you can only move so much money out of the country. Bitcoin potentially offers a way around that, an escape valve. And that's why proponents say it matters for the future of money. It allows economic activity outside the permission structure of the state. Maybe you're a business trying to pay someone across a border with sanctions. Or just an individual in a place like, say, Venezuela or Lebanon, seeing your currency collapse due to hyperinflation. The ability to send and receive value without needing permission from a central authority, that's the core value proposition there.
Okay, that foundation, scarcity resistance, it's definitely compelling. But the theory is one thing. Is it actually catching on? Is it integrating into the real world? Let's look at the adoption trends, because we're seeing different things happening at the government level versus, say, institutional or retail. And the results are, well, they're mixed. We definitely have to talk about those government experiments. El Salvador obviously made Bitcoin legal tender back in 2021. Then Central African Republic did something similar. But the research, the sources we looked at, they highlight that these big state-level moves, while revolutionary on paper, have really shown how difficult mass adoption is. There have been struggles.
Yeah, the El Salvador case is particularly interesting if you want to understand real-world hurdles. It wasn't just about the price volatility, though that was definitely a factor. The sources point to specific problems, like technical glitches with the government's digital wallet, the Chivo wallet, things like not everyone having reliable internet or smartphones, especially outside the cities, and maybe the biggest thing, a lack of public education. People just didn't understand it or trust it, so there was a resistance. Many just stuck with cash, the US dollar in their case, because they understood it. So the lesson seems to be that just passing a law isn't enough. You need huge investment in infrastructure, education, really changing the culture. It takes time.
Right, so state adoption is proving slow, maybe messy, but retail adoption, just regular people buying it, that seems to be moving much faster, largely because it's just gotten easier, hasn't it?
Oh, absolutely. Think about how you'd buy Bitcoin back in, say, 2013 versus now. It was complicated. Now, you've got mainstream apps like Cash App, PayPal, Robinhood, Coinbase. They've integrated it pretty seamlessly. They handle all the tricky stuff behind the scenes, like custody, where the Bitcoin is actually stored. For the user, it feels almost as easy as buying a stock or sending money to a friend. That simplification, it has just dramatically lowered the barrier for millions of people globally. It's taken Bitcoin from this niche tech thing to something much more like a global commodity people can access.
But maybe the biggest shift, certainly in the last few years, has been the institutions getting involved. That feels like a different phase entirely. We're talking huge names, BlackRock, Fidelity.
Yeah, that's a massive signal. When the traditional finance giants step in, it suggests Bitcoin is moving from the fringes towards the core of how global assets are managed. And their role isn't just about bringing money in. It's about creating the plumbing, the regulated pathways for conservative investors. By launching things like the spot Bitcoin ETFs, they solve the main headaches for big institutions. How do we hold it securely? Is it compliant? How do we report taxes easily? Their involvement basically gives the green light, legitimizes it for pension funds, endowments, even sovereign wealth funds, entities that often can't touch unregulated assets directly because of their mandates. This institutional infrastructure is what could really unlock widespread adoption within the established financial system.
And you can't talk about institutional conviction without mentioning MicroStrategy. Michael Saylor, they've gone all in, haven't they? Is that strategy seen as, I don't know, visionary or just incredibly risky?
Well, MicroStrategy's approach, putting Bitcoin on their corporate treasury, it's definitely worth digging into the why. Saylor's argument, which comes up a lot in the source material, is fundamentally macroeconomic. He basically views holding large amounts of cash as a liability, not an asset, because of long-term fiat inflation. Especially after years of quantitative easing, money printing. He argues Bitcoin isn't just speculation, it's a superior treasury reserve asset, something that holds its purchasing power better than cash over the long run. So that shifts it from just a trade to a core corporate strategy against what he sees as inevitable monetary debasement.
That's a bold bet, though. The sources must talk about the risk, surely. I mean, what if inflation cools off? What if the dollar stays strong? Isn't putting your company's treasury into something so volatile kind of reckless?
Oh, it's absolutely seen as aggressive. And the sources definitely acknowledge the volatility makes it unsuitable for most companies' treasuries right now. But the rationale, Saylor's rationale, it hinges on the very long-term trend of central bank behavior. Decades, not quarters. MicroStrategy's bet is essentially that over the long haul, governments will have to devalue their currencies to manage massive debts. It becomes almost inevitable in that view. So even if Bitcoin crashes 50% next month, its long-term deflationary nature that fixed supply makes it the winning play over decades. It's a risk assessment, sure, but it sees fiat currency as carrying its own, perhaps slower moving, but ultimately larger risk. And, to put this adoption growth into perspective, one of the sources used a pretty good analogy. Compared Bitcoin's adoption curve to the internet back in the 1990s. We were trying to get online in like 1995. Dial-up screeching is slow, clunky, seemed kind of useless for most daily things. But fast forward a decade and it totally changed everything. So the argument is, if we're still in the early days of institutional adoption now, maybe equivalent to that early internet phase, then the potential growth, using that history as a guide, could still be absolutely explosive. Maybe we're closer to the AOL era than the Google era,
And we can actually see evidence of that long-term belief, that willingness to ride out the ups and downs in some of the on-chain data, right? These aren't just opinions, they're measurable actions.
Exactly. Let's talk about ODL waves. ODL, HODL, for anyone who hasn't heard it, it's become crypto slang for hold on for dear life. It started from a typo years ago, but it captures this culture of long-term belief. So HODL waves, as a metric, they show you what percentage of all the Bitcoin out there hasn't moved from its digital address in a certain amount of time, like hasn't moved in over a year or 5 years or even 10 years. And what we see is steady growth in those longer term bands, the 1 year plus, 5 year plus holders. It suggests real conviction. People are buying Bitcoin and basically taking it off the market, putting it into deep storage, treating it like a generational asset. That itself reduces the liquid supply available to trade, which reinforces the scarcity idea. Plus, you also see this steady increase in the actual number of wallets holding, say, more than one whole Bitcoin, which suggests that more serious investors, whether they're wealthy individuals or starting to be institutions, are building up positions over time. It signals the market is maturing.
Okay, so far we've talked a lot about Bitcoin as a store of value, something you buy in HODL, right? That long-term belief. But if it's really going to be the future of money, it needs to work as money too, as a medium of exchange. It needs to be efficient, cheap to use for actual transactions. And the original Bitcoin network, the main layer, it was designed to be slow, even expensive, wasn't it? Because the priority was security, decentralization, not speed.
Exactly right. That focus on security meant the base layer, layer one, it functions more like a big settlement system. Think about huge transfers between central banks. They're slow, they're secure, they cost something. Bitcoin's main chain is like that, which is why the growth of infrastructure, especially scaling solutions, is so incredibly important. And the biggest development here, the one that really challenges that Bitcoin is only digital gold idea, is the Lightning Network. It's what's called a layer 2 solution, built on top of the main Bitcoin blockchain.
Okay, explain Lightning for us. How does it actually change the game? How does it make Bitcoin potentially usable for, like, buying coffee when the main network is so slow?
Right, so Lightning basically changes the physics of small Bitcoin payments. Instead of every single tiny transaction having to be recorded forever on the main blockchain, which is slow, takes energy, costs, fees, Lightning lets users open up these secure payment channels between each other, off the main chain. Transactions inside that channel, maybe you're paying for streaming content by the second, or buying that coffee, they happen instantly. And the fees are tiny, practically free. Then, only when you decide to close the channel, the net result, the final balance between the parties, gets settled back onto the main, super secure Bitcoin blockchain. This kind of architecture, it potentially transforms Bitcoin from just a slow settlement layer to something that could handle millions of instant tiny payments per second globally. So you get this dual system, the slow, rock-solid base layer for big, important settlements, and this fast, cheap layer on top for everyday spending. That's why it challenges the only digital gold narrative. The aim is to be both the vault and the payment rails.
Okay, but wait. If Lightning makes it easy and cheap to spend Bitcoin, doesn't that kind of undermine the whole HODL store of value thing? If people are encouraged to use it daily, aren't they more likely to sell when the price dips, making the volatility worse and hurting its stability as a long-term store?
That's the core tension. You're absolutely right. The source material tends to argue, though, that the two functions can actually support each other. They're not necessarily competing. The idea is Bitcoin, the base asset, remains the ultimate reserve, the non-inflatable digital gold. But the actual day-to-day spending might happen using capacity on the Lightning Network denominated in Bitcoin, or maybe even using stablecoins that settle over Lightning. So you might be spending Bitcoin in a sense, but the underlying asset itself stays scarce and secure. It acts as the ultimate collateral backing the whole payment system built on top. The integrity of the store of value is what gives the medium of exchange its foundation. That makes sense. Now, let's shift gears slightly to network strength. Security. This is fundamental, right? If the whole point is trustlessness, decentralization, how do we know the network itself is secure and resilient? The key metric here is the global hash rate and its growth.
Okay, hash rate. What does that actually mean for someone listening? Why is it growing, and why is that so critical for the security model?
So hash rate is basically a measure of the total computing power that miners all around the world are dedicating to securing the Bitcoin network. Think of it as the raw processing speed trying to solve the complex math problems the proof of work needed to validate transactions and add the next block to the chain. A higher hash rate means the network is more secure. Why? Because it makes what's called a 51% attack incredibly difficult and expensive. A 51% attack is the theoretical risk where some entity, maybe a hostile government or huge corporation, tries to gain control of more than half of the network's total computing power. If they did that, they could potentially manipulate the transaction history, like double spending coins. Bitcoin's security model relies on economics. The sheer cost of buying or building enough specialized mining machines, that's the capital expense, CapEx, plus the ongoing cost of electricity to run them, the operational expense, APEX. It makes trying to get 51% just astronomically expensive. So the fact that the global hash rate keeps climbing steadily year after year,
It proves the economic incentives to secure the network, honestly, are massively outweighing any incentive to attack it. It's the ultimate measure of the network's resilience.
Okay, so the network's getting stronger, more secure, there's infrastructure like Lightning being built, but we still can't get away from that volatility problem. It feels like the elephant in the room. Even a company like Tesla, an early big institutional believer, seemed to struggle with it publicly.
Yeah, the Tesla story is a really important case study. It shows how volatility impacts real-world corporate decisions, even on those initially enthusiastic. Their initial big purchase of Bitcoin in early 2021, that was a huge news, gave Bitcoin a massive boost of mainstream legitimacy almost overnight. But then they sold off a significant chunk. And while Elon Musk talked about environmental concerns with mining energy, the ESG angle, the sources we reviewed, make it pretty clear that managing the volatility was a major factor for their Treasury Department. Think about it from a public company perspective. When the value of an asset on your balance sheet swings wildly, up or down 20–30% in a quarter, that creates huge, unpredictable noise in your earnings reports. And Wall Street hates unpredictability. So the Tesla example really highlights that even if a company believes in Bitcoin long-term, philosophically, the short-term price swings make it really difficult to manage within the normal constraints of corporate finance and reporting. Volatility is still arguably the single biggest hurdle for deep integration into traditional, conservative corporate balance sheets.
right? So we've laid out the strengths, right? That absolute scarcity, the network security getting stronger, institutions building regulated ways to get involved. But let's be realistic. For Bitcoin to reach that grand vision, a global decentralized currency, there are some major roadblocks still in the way, big challenges. And the number one, as we just discussed with Tesla, it's still that high volatility compared to regular currencies like the dollar or euro. For something to work well as a unit of account, meaning you price goods and services in it, you need stability. Businesses can't easily set prices in Bitcoin if it might drop 15% tomorrow and wipe out their entire profit margin. That instability forces most merchants who accept Bitcoin to immediately convert it back to fiat currency, which kind of undermines its use as a day-to-day currency.
And that volatility problem, it often gets amplified by the lack of clear rules, doesn't it? The regulatory situation.
Exactly. That's the second huge issue. Regulatory uncertainty. We still don't have clear, consistent rules across major economies like the US, Europe, Asia. It's more like a patchwork quilt right now. Is Bitcoin a commodity? A security? Property? How is it taxed? How should banks handle custody securely? This lack of clarity creates major headwinds. Big traditional financial players, they thrive on clear rules. They need regulatory certainty before they can fully commit massive amounts of capital. Until there are harmonized global rules covering everything from security standards to tax reporting, the full weight of the established financial system probably can't easily integrate Bitcoin. Getting that clarity is arguably the key to unlocking the next level of institutional adoption.
Okay, so internal challenges like volatility and regulation. But Bitcoin isn't the only game in town anymore, is it? There's a whole universe of other crypto projects, other narratives competing for attention and capital. Yeah, we definitely need to acknowledge the competition, especially from other big layer 1 blockchains. Things like Ethereum, Solana, they're serious contenders. While Bitcoin really doubles down on being super secure digital gold, these other platforms are built around smart contracts. That means they can run complex, decentralized applications, or DApps, think decentralized finance, DeFi, NFTs, tokenizing real-world assets, basically programmable money. They offer this vast potential for utility, for building new financial systems in a way that Bitcoin's simpler design doesn't easily allow. So they present a very different, very compelling vision for the future of digital assets.
And that sets up this fundamental kind of philosophical clash within crypto, doesn't it? What's ultimately more valuable? Is it Bitcoin's absolute immutability and digital scarcity, that guarantee of being unchanging digital gold? Or is it the infinite flexibility and programmability offered by platforms like Ethereum, that potential for endless innovation? They can't really both be number one in the same category. And then, layered on top of that, you have stablecoins. These are digital tokens pegged one-to-one to fiat currencies, usually the US dollar. They give you the benefits of blockchain-fast, global, transparent transfers, but without the wild price swings of Bitcoin or Ether. For everyday payments, for trading, for DeFi, stablecoins offer a really practical middle ground right now. They solve the volatility problem today, and that directly challenges Bitcoin's usefulness for daily transactions. Because why use something volatile when you can use a stable digital dollar instantly?
Which brings us neatly to a really provocative question that came up in the source material. It kind of sums up this whole competitive dynamic. If you had to pick just one, Bitcoin or Ethereum, which one is the real future?
Yeah, that's a great question. And as we kind of touched on, maybe it's a bit of a false choice because they're arguably designed for different things, different layers of the potential future financial stack. Bitcoin aims to be the base layer, the ultimate scarce neutral reserve asset, the digital gold, the money. Ethereum and its competitors, they're more like the application layers built on top, the software platforms for using that money or other digital assets in complex and programmable ways. The engine, maybe. So the debate is really about which layer is more fundamental or more valuable long-term. Do you need the rock-solid scarce foundation first? Or as the utility layer where the real action is? Increasingly, though, you hear the narrative that they might actually be complementary, codependent even. Maybe Bitcoin serves as the ultimate collateral, the base money layer for the whole system. And Ethereum provides the smart contract functionality, the engine, to actually do interesting things with that collateral in the world of DeFi and Web3. That tension between them, that competition, it also forces both networks to keep improving, right? Bitcoin needs better scaling like Lightning.
Ethereum needs better security and maybe eventually less inflation. Competition drives innovation. So if we try to tie all these threads together now, look at the really big picture. What seems to be emerging is Bitcoin positioning itself as, that fundamental base layer, the immutable foundation, not just for its own network, but potentially for the broader digital finance world, the whole Web3 ecosystem. Even as other blockchains like Ethereum handle more complex stuff, their ultimate security, their deepest value, might still rely on connecting back to Bitcoin somehow, which brings us this really important concept, interoperability. How can the value and security locked up in Bitcoin be used safely within, say, the DeFi ecosystem running on Ethereum, or with tokenized real-world assets, or these new Bitcoin Layer 2 solutions that are popping up?
Right. How does that actually work? If Bitcoin is on its own separate track, how do you get its value over to Ethereum to use in DeFi without creating some huge security risk?
Well, the main way it's done today is through something called wrapped Bitcoin, or WBTC. It's basically a token on Ethereum or other chains that's backed one-to-one by real Bitcoin held somewhere else. How it works is you send your actual Bitcoin to a custodian, could be a company, kind of like a specialized bank, and they lock it up securely. Then they issue an equivalent amount of WBTC token on the Ethereum network. Now, that WBTC can be used in all sorts of WBT pacers, lending, borrowing, providing liquidity. It effectively brings Bitcoin's massive value into the Ethereum ecosystem. But there's a catch, right? That solution relies on trusting the custodian who holds the original Bitcoin. It introduces a point of centralization, a counterparty risk. So the sources suggest that the real key to unlocking Bitcoin's full potential as the base collateral layer will be developing trust-minimized Layer 2 solutions directly on Bitcoin itself, or better bridges that don't rely on a single custodian. That's where a lot of development is focused now.
Okay, let's pivot back to the macro picture. The classic argument for Bitcoin, especially from the early days, was as a hedge against inflation, against global economic turmoil. Does the data actually back that up? Can it really be called a safe haven asset when it's still so incredibly volatile in the short term? Well, the analysis seems to show it's kind of complicated. There's a bit of a split personality there. In the short term, Bitcoin often trades more like a risky tech stock, doesn't it? A risk-on asset. Meaning when the stock market's doing well, Bitcoin often does too. But when there's fear, uncertainty, a flight to safety in global markets, Bitcoin sometimes drops along with stocks. Exactly the opposite of how gold usually behaves. That makes the safe haven label tricky.
Right. But the source material, especially from the long-term bulls, tends to focus less on those daily correlations and more on the very long-term secular trend. The argument there is that over decades, Bitcoin acts as a hedge specifically against fiat currency debasement, the slow, steady erosion of purchasing power from inflation and money printing. In times of really extreme stress for a specific country's currency, like hyperinflation or maybe a sovereign debt crisis, Bitcoin's non-sovereign nature, its fixed supply, makes it look very attractive as an alternative. So its long-term value proposition is argued to be counter-cyclical to the health of government-issued money. It's pitched as digital insurance against that long-term risk. And the high volatility, well, that's seen as the price you pay for potentially accessing that insurance policy early. That's part of the rationale for institutions like MicroStrategy getting involved betting on that long-term macro trend.
And we can maybe ground this whole discussion by looking at the historical performance numbers, which are often, well, pretty staggering.
Yeah, let's touch on that key comparison. Bitcoin's 10-year ROI return on investment versus traditional stuff like the S&P 500 index or gold. Now, the exact numbers change depending on precisely when you start the clock, but the pattern is consistent. Historically, Bitcoin's return over a decade has just blown away both the S&P and gold. We're talking orders of magnitude difference sometimes, thousands of % returns for Bitcoin versus maybe dozens or low hundreds for the traditional assets over the same period.
And that dramatic outperformance, historically speaking, it does validate that core HODL strategy for people who got in early and held on through the massive price swings. It shows that despite the crazy volatility, the 80% crashes we've seen multiple times, the underlying network effect, combined with that program scarcity, has historically driven incredible returns. For a growing number of serious investors, that track record, even with all the risk caveats, is becoming a powerful piece of evidence. It supports the idea of having some allocation to Bitcoin in a diversified portfolio, especially if you're concerned about the long-term picture for traditional currencies and assets. Hashtag outro.
Wow. Okay, what a deep dive that was. We've covered a lot of ground here. From Satoshi's white paper back in 2009, born out of that financial crisis, through the experiments, the institutional buy-in, the tech developments, all the way to where we are now, a globally recognized asset, but one still facing big hurdles, tough competition from the wider crypto world. So for you listening, hopefully the key takeaways are becoming clearer. Bitcoin's core value prop really hinges on that absolute scarcity, 21 million coins, period. Enforced by math, by the code, the halvings, its security network is getting stronger all the time. You can see it in the hash rate growth. And maybe most importantly, it seems to be evolving. It's not just digital gold anymore. With things like Lightning, it's also aiming to be a fast global payment network, trying to be both things at once, the secure vault and the super fast highway for digital value.
Yeah. It's still polarizing, though, no doubt about it. And where it goes next really depends on how that tension revolves. The tension between its strengths, scarcity, security, decentralization, and its weaknesses. Volatility, the regulatory fog, the competition. The big question isn't really, is Bitcoin volatile today? We know it is. The question is, can that fundamental scarcity ultimately win out over the friction from regulation and the challenge from these other blockchains focused on utility? That's the multi-trillion-dollar question, I suppose. So maybe we can leave you with that final provocative thought pulled from the research. Do you see Bitcoin hitting $1 million a coin in your lifetime? Or do you think it ultimately fails before it gets there? Think about that balance we discussed. The huge potential upsides. Digital scarcity, censorship resistance, weighed against the very real downsides, the volatility, the regulatory risks. Where you land on that probably determines how you see Bitcoin's future, and maybe the future of money itself.
Absolutely. A lot to think about. Well, thank you for diving deep with us today. And hey, if you got value out of this breakdown, if you found this deep dive into the Bitcoin sources useful, please do consider engaging with the video, subscribing, leaving a comment, hitting the like button. It genuinely helps us out a ton with the algorithm, boosts visibility, and that lets us keep putting the time in to create more of these in-depth deep dives for you. We really appreciate the support.